Hey, welcome everybody. We're glad you're joining us today. My name's Stephen Ness with Lyft, and this is called Becoming Business Lendable. Today we have a very special guest with us, a good friend of mine. So Kevin Thornton, why don't you go ahead and introduce yourself,
Hi,
sir?
my name's Kevin Thornton. I am an SBA Business Development Officer for Milestone Bank. We are a nationwide 7A lender. We're in all 50 states. And I've been in the banking industry about 20 years here in Las Vegas.
Awesome. I appreciate it.
Yeah,
Thanks for joining us today.
Good friends with Steve, by the way.
Yeah, me and Kevin go way back. We were at a previous lender together. He was one of the two people I actually allowed to work with my clients. So I've been in the industry a lot, and you get a lot of people that just don't get deals done or don't have the willingness to help someone to say, okay, maybe not yet, but how do we get there tomorrow or the next day? And so I've exclusively built a network of lenders throughout the nation that I work with, and Kevin is definitely one of those. So today what we're going to focus on is the lender's point of view. The idea that as a business owner, when you go to the bank, of course, we have our idea, like this is what I look like, this is how good my business is. But in reality, there's all kinds of factors that the financial institution looks at. And it's very often difficult to understand, and sometimes it just doesn't even make sense. So our goal is to make that as relatable as possible, to simplify it. So feel free, if you have questions, jump in. We're happy to answer anything throughout this process, because our goal is to transfer as much of information as we've stored up to as many of you as possible. So with that, I'd kind of like to start just a little bit about my company. So my company is called Lyft. It stands for Looking Inward for Tomorrow. We've been in operations for over 2 years. We funded over $20 million in our first 2 years, most of which has been SBA lending, although we have placed some other lending as well. Our values are leadership, integrity, faithfulness, and tenacity. My personal favorite, and I'm sure Kevin could attest to this, I'm kind of known for tenacity. I'm always the guy that's kind of ruffling feathers or pushing that edge forward. And the reason that Lyft got founded was because in the major financial institutions that I've worked at, about 80% of the clients that came in looking for lending, unfortunately, didn't even get to an application. And that wasn't because they didn't want to go to an application. It's because I didn't want to take a good person through a bad process. And in reality, if the financial institution that I was working at couldn't do it, like the major big five, then we had to go somewhere else. So that's where Lyft was formed. We focus on 4 areas. We do leadership development, business optimization, capital engagement, which is everything to do with money. That's what we're here to talk about today. And then strategic partnerships. So our goal is to really help any entrepreneur locate the resources they need, identify ways forward, and then get the capital to make that happen. We like to say that we are a people organization because everyone has success planted inside of them. But depending on where you're born, what you look like, for me, if your parents were not drug addicts, which lucky for me, they were, right? The idea is that can change your trajectory in life. You like that joke, right? Obviously, I wasn't very lucky for having that, but it changed the way I looked at life, right? It made it very difficult for me to even create what is an inner vision for myself, or actually believe I had a way to achieve that. So we help individuals develop that inner vision, achieve it, and then we work with entrepreneurs from 1 to 100 to find capital to grow their businesses, whether that's through revenue financing, also known as bootstrapping, lending, or investment. So today we'll primarily talk about lending and what that looks like, because that's my favorite type of way of helping an entrepreneur, because it's non-diluted capital, meaning when you get a loan, the lender doesn't take a piece of your company. You don't have to pay him profits every year. You just got to repay that loan. And once it's done, you still own 100% of your company. Mm-hmm. And our goal is to really transform individuals and transform companies to create wealth, right? And so today, Kevin, we have Kevin Thornton from Milestone Bank. So why don't you tell us a little bit about Milestone?
Yeah, so Milestone has been around as Milestone Bank for a little over a year. It was the result of a rebrand Lease Corporation of America. We were primarily an equipment finance company, I think since 1988. And last year, a couple of years ago, the SBA opened up their PLP program, their preferred lender program, to a bunch of banks, a bunch of PPP lenders. This is a post the pandemic. And we wanted to get in on that. So I represent kind of the West Coast. People were confused. They were like, why are you calling me about an SBA loan? You're a lease company.
Yeah.
So we rebranded to Milestone, and we've been kind of firing on all cylinders ever since. And we do SBA 7A lending nationwide. That's startup, franchise financing, working capital, business acquisition, and commercial real estate. And we're a smaller team, but that gives us a lot of flexibility the bigger banks just don't have in some cases, not to besmirch them, of course. But, you can actually talk to decision makers. You can come up with creative solutions to help the end client. And to Steve's point, hopefully get to that yes more often.
Yeah. And a good example of that is we talk about where you pre-flight a packet, which we'll get in later today. But, Kevin, I sent him one just this weekend. I think it was Saturday. And he already got back to me on Veterans Day. So how many of you think a major bank's going to call you on Veterans Day to talk about your deal? They were closed, but he was still working. And that's one thing you'll learn. It's all about the partnership.
And you got to manage the workflow. And you want, ultimately you're trying to help the end client, the customer, build their business or get a business or be successful. Every day counts in that situation. And if you've got the free time, I believe, use it, deliver that customer service.
Yeah, I like how you said that, actually. We believe that in most cases, the financial transaction we're helping a business owner with is their most important financial transaction of their life.
Absolutely.
Right? If you've already bought a home, you already have these other assets and you're going through it. I have some customers that told me they don't get it. Like, this is my life. I don't know what happens if we can't get this loan. Yeah. And it's nice to work with people that treat it like that. So today, what we're going to talk about is we've got an agenda here. We're going to talk about what does the bank look at, right? So this is the lender's point of view on you and your company, what kind of profile they build for you. The purpose of the loan, that's a big one because that can dictate where we flow through SBA, and Kevin can share tons on that. We'll talk about different loan types that are available out there. Then we're going to discuss really lender preference. It's the idea that just because they said no doesn't mean you're not lendable. But it's also the idea that just because they said yes doesn't mean that's the right capital for you. So we'll talk a little bit in that. We're going to go over some of the basic terms and pricing. So that's going to be a little bit boring, not even going to lie, right? But it's that needed education that's there. We'll walk you through what that underwriting process looks like, which is very helpful so you understand where you're at and what's coming. Then assuming you get approved, there is another process through the closing that you have to walk through. We'll discuss there. And from that, we're going to open up to questions. So anything you want to know, need to know, we're going to help out with that. So when we talk about the company and owner profile, I teach an entire class on this. And if you joined me last month, we actually went in depth to this. But I'm going to give this to you, Kevin, right? Because you are at a lender, and I know you know the 5 C's. Literally, when we call each other, you're telling me what's the capacity? Do they have collateral? What's their credit look like?
Yep.
Right? So why don't you talk
it's like
through a few of these?
The ABCs of lending. It's the first thing that lenders learn is this 5 C's of credit. And this pretty much encapsulates everything. Let me backtrack. Each lender has a different criteria that they lend to. They have their own underwriting policies, procedures, but all of it can basically be whittled down and attributed back to these 5 C's of credit. The first is credit. That one's pretty self-explanatory. Do you, the borrower, have good credit? What does your credit look like? You can get very granular there, but basically, do you have good FICO? Bankruptcies? Have banks taken losses? What does your financial situation holistically look like? That's obviously important.
Yeah, I got a question on this one because there's a big misconception. So if I have bad personal credit, and can I just rely on my business credit to get a loan?
No.
Right? So I want to make sure everyone hears that. That's directly from a lender. And I'm going to reiterate that so often because it's a myth we need to bust out there, right? You exist without your business, right? If your business isn't there, you as a human being still exist. But your business will not exist without you. And because of that unique dynamic and relationship, your personal credit is always going to matter when it comes to getting business credit.
And also remember, especially in the SBA world, but in most conventional lending too, you, the human being, are ultimately the person responsible for the loan you took out, even on behalf of your business. We're going to come after you. We're going to say, hey, you owe us money. So we're going to qualify you. You're going to be a guarantor on the loan typically. And that's where that personal credit is very important. So
yeah, that's a good point. With an SBA loan, there's no walking away from it. Even if your business fails,
you've got an LLC and I'm removed from that.
Not with
We're
an
knocking
SBA
on,
loan.
yeah, they're knocking on the door. It doesn't
Yeah.
matter.
You can't even file bankruptcy on it. If you file bankruptcy, they're still going to turn you over to the largest collector in the land, also known as the IRS, and they go and get their money, right? So go ahead. What's the next one here?
The
Capacity.
next is capacity. So capacity is your ability to borrow credit. Capacity can take on different forms depending on the deal that we have. A common one where capacity is important is a business acquisition loan, where you go in, you buy a business, and you're buying an existing business that generates its own revenue and net income, right? You're relying on that business to basically, the way we look at it is we want that business to pay for itself. Does the business stand alone, and can it generate enough income to pay its own debt? And then how much can that debt be? That's where your capacity falls into place. People bring up DTI ratios, things like that. And a common misconception, and you run into this all the time, is people think about business lending like it's a mortgage, because it's the biggest reference point they have to a bank and the biggest transaction they've done beforehand, but it's not the same. We are very much cash flow based, capacity based. That's why these 5 C's are so important in the business world.
Yeah. And that's a great thing to point out, because different lenders are going to put different emphasis or more or less emphasis on one of these areas.
Yep.
The main 3 being these top 3: credit, capacity, and collateral. Typically speaking, a lender is going to have a preference towards either being a collateral lender, where they say, hey, I require collateral on every deal or I don't do it. Or they're going to be a capacity lender where they say, hey, we prefer to see the cash flow pay here.
Exactly.
So it's a good thing to ask about the lenders you're engaging. Hey, do you have a preference towards capacity, towards collateral?
Yep.
Right.
Yep.
Now, collateral is pretty simple. It's like, what do you got? Right. But what are some of those things that business owners tend to skip over, or things that can be used as collateral that people don't think about?
On the SBA side, it's unique. So the SBA, it's called the SOP from the SBA, the Small Business Administration. Their guidance is effectively collateralize what you can. And what a lot of business owners or prospective business owners don't realize is that the first thing they look at is your personal residences and your properties, if you have it as collateral. So the SBA is a unique program in that we can do uncollateralized loans. We can do loans where there's actually no collateral or minimum collateral, but if you have it, we're going to take it. And in a way, you're almost punished for being successful, right? If you've got multiple investment properties, we're going to take as much as we can to fully secure that loan. But if you have nothing, no collateral, but you still qualify, I know it's hard to kind of, but it also is something.
A great way to put this is under the SBA SOP, Standard Operating Procedures, and SBA stands for Small Business Administration. That's the government entity that is guaranteeing an SBA loan. But the way it's written is, if you don't have collateral, that's not enough for us to decline you.
Right.
But if you do have collateral, we need to capture up to 70% of the loan we're issuing out at a minimum. Some lenders can say, hey, no, we want to go up to 90, or we want if you've got it, we're taking it, right? There are plenty of lenders like that. But that's why you got to talk with lenders. I also have a lender that says, hey, if you do less than $500,000, we're not even going to ask about collateral, even if you have it, right? So the idea is there's tons of variance between lenders. Conditions. I think this is the borrower's least favorite part, right?
Yeah. Conditions is all the ancillary, what do you want to call it? Tag-on stuff?
I always like to say it's the condition to get the loan, right? Like, okay, you want this money, you're approved.
Right.
Now here's my conditions if you want this money.
And a lot of that is that collateral piece we discussed. You're going to have to collateralize some homes. You're going to have this money, and we'll talk about post-close liquidity later, but just all of the things. Okay, on the outset, we like this deal. We like you, the borrower, and we're willing to move forward with it in the event that you bring all these things to the table to make it happen. And sometimes it's not a big deal. Some borrowers are passionate. They just, whatever you need, we'll do it. And there can be negotiations, but ultimately it's, you're pre-approved, let's just say, but you gotta check all these boxes off for us to be comfortable with it. And the conditions can vary greatly depending on the borrower. So, maybe we want to get a spouse involved, or maybe we want to collateralize 2 investment properties, or maybe, there's seller notes. I mean, there's just so much that goes into it that we can dive into, but that's what the conditions are basically is, hey, we like it, but you gotta meet these conditions.
Yeah, exactly. Right. It's really whatever they're going to require you to do in order to get that loan. And the nice thing is banks are very clear about this. The problem or the frustration that borrowers get is, you get conditions after you submit documentation. So here the lender says, okay, this is what I need to go forward. Then you submit it to them. And then they look at that. They're like, oh, well, I didn't know I was going to see this on your tax returns. Now I have another condition, right? Or I didn't know I saw this on your bank statement. Now I have this condition.
And that happens all the time. You get a loan, and then it turns out the building's owned by one company as an LLC, but that company's owned by another company, and now I need all that documentation. Little things like that. There's a lot of back and forth. It's a dynamic process.
Yeah, absolutely, right?
Yeah.
And then last we have character.
My favorite one. Yeah.
Your favorite. I love it. Tell me about that.
That is you, the borrower, entirely. That is, do we think you have the experience for this industry? Do you have your paperwork together? Are you honest? What does your credit report look like? I'll tell you, until AI completely takes over this industry, underwriters and credit managers and BDOs are human beings. And they're looking at every piece of paper you turn in when you apply for a loan. And even little things you think that don't matter, the way your application's filled out. Is it legible? Is it well written? Does it capture your total financial picture?
Yeah.
Those can bias a banker, an underwriter, to decide whether or not they like you. Not like you, that's a bad way to put it, but does this person seem like they've got it together enough that we're willing to lend them $1 million for a business?
Yeah, and I've seen this come into play before, where, you know, a well-crafted business plan that tells a really good story and explains it can help an underwriter have a different view of you, right? Whereas let's say you submit some information in, and then the next information you submit in is completely contradictory to what you previously submitted. Now that human being behind it is going to go back through everything with a fine-tooth comb.
Yep.
Whereas previously they maybe have brushed it over. Now they're looking at like, oh, wait a second, I need to go back and dig into this. Did this person talk about their marketing strategy? Or if there's a unique problem with reaching their key demographic, what are they going to do to fix that? Or did they even identify their key demographic?
We're almost like defense attorneys in a way. And then the underwriter,
well
the higher ups of the banker, the prosecution or the judge, where I sit with you as a borrower, I say, look, be honest, just tell me everything. Tell me everything up front. Bankruptcy, short sales, foreclosures, did you, criminal background? Just let me know up front, and we can mitigate it, and we can work toward a resolution. But if I find out on the 11th hour and you weren't honest with me, and then I've got to explain that to the higher ups, it's bad for everybody, you know?
Yeah, they actually question his character in that now.
Yeah, because we want to be upfront and honest, because we can mitigate if we know in advance. You know, it's all about being prepared.
Yep, absolutely, right? So that's kind of how the lender looks at you. Now let's talk about this loan purpose, or I like to say matching credit uses, so to speak, right?
I like that.
One of the most obvious examples I give about this is, unless you're someone who can really afford to, right? You're a multimillionaire, you're probably not going to go buy a home on a credit card, right? Because especially if it's like an Amex Black, right? But the idea is a credit card is short-term expenses. You need to pay them off in a short period of time frame, right? So why don't you tell us a little bit about how Milestone looks at credit matching and credit uses?
Yeah, we don't really, the way we look at it, and a lot of banks do, is we basically look at all of your debt on your personal financial statement and your living expenses. And then we say, okay, how much does it, and then we might add a little bit of a percentage on top of that for a cushion. And we say, how much does John Doe need to live off of on an annual basis? And can he support those living expenses plus the additional debt that he's looking to incur with the loan? Either a business acquisition is a big one. Yep. Is there enough money in there for him to take a salary out of that business and still maintain that debt payment? Working capital, can he deal with the extra debt? That's really how we look at credit. DTI, I mean, that affects your FICO, but it's not like in the mortgage world where,
what's DTI?
Debt to income, your credit utilization. So credit utilization is important, but it's not something that SBA lenders like hone in on, as long as ultimately you're making enough money to pay your debt.
Perfect.
Yeah,
right?
That's how we look at it.
And that's nice, because that means they can lump in a lot of different things into, say, an SBA loan, where some other lenders may say, okay, these payroll expenses, these marketing, these monthly expenses, maybe we want you to have a revolving debt for that, because that's something you should be paying off on a monthly basis, right? So that's good to know that that matching is available there. With other lenders, you have to just go case by case, right? Like if it's a long-term equipment, like what I see so often is every business owner that's just getting started, they all tell me they want a line of credit, right? And I'm like, I get it. A line of credit is a blank check. You get to reuse it over and over again, right? You use the money, you pay it back, you use it again. What you got to understand is, from a lender's perspective, my risk in you is renewed every single month. My risk never goes down when I issue you a line of credit, because you can use that money over and over. With a loan, the lender's risk goes down over time. You get $100,000, you start paying it back. My risk goes down as you've paid it down, because you can't just re-up your loan to $100,000 that next month like you can with a line of credit. And I mention that because in reality, if you're not in business for 2 years and you don't have cash flow, you shouldn't be seeking a line of credit, or you're really just, beating your head against a brick wall. It's going to be very difficult to get a line of credit in that case, even if you are the most phenomenal borrower on a personal basis. Right. So any other thoughts about the loan purpose there?
No.
I mean, I guess when we talk loan purpose, there are some things that SBA doesn't allow, right?
Yeah. So prohibited industries, anything the government wouldn't want you to do with the money, you're probably not going to get done. Hemp, well, not really. Marijuana.
Hemp's okay. Well, CBC okay. THC's not.
It is, but there's still that bias in a lot of business.
Yeah.
A lot of banks don't touch it. It's kind of a case by case. But obviously, if it's something the government prohibits, it's not something that we're going to be able to do. Nonprofits are out, and churches, nonprofits in general are out.
Yeah, you can't use SBA lending. You got to find a particular lender for your nonprofit. Which
Correct.
It's hard as a nonprofit, and in my opinion, it's really just the bad press associated with it. Like Milestone Bank or any other bank doesn't want a headline that says this bank took back the church, or this bank took this from a nonprofit, right? There's so much bad press in that it's really hard to find lending for nonprofits unless you've been in operations for 2 years and have cash flows and all those things as well. The other thing with a nonprofit is there is no owner.
Yeah.
Right. Like if on a legal basis, you don't actually own it. It's his own separate entity. So there's no way for them to get a personal guarantee. So there's no one on the hook if it fails.
Yep.
Right.
Yep.
All right. So let's talk a little bit about the different types of loans. So I know you've mentioned some SBA and equipment finance. So why don't you talk a little bit more about the SBA 7A, just kind of high level, if you would.
So the 7A is the SBA's generalist lending program. Its limit is $5 million. And that's your business acquisition, your commercial real estate, your working capital. I mean, pretty much everything can fall into that category. Yeah. And that's where we focus at Milestone, by the way. There's another loan type that's very prominent in the SBA world called the SBA 504 loan for large equipment and real estate purchases. The way that works is it's the bank and what's called a certified development company, the CDC, and they're state run in some cases, and they've got a few in each state. They marry together, and the bank says, we'll do, let's just hypothetical, we'll do 5 million, and then Steve's at the CDC, he'll do the other 5 million. And that breakdown's not exact, but just to keep it simple. And that's a $10 million loan. We don't participate in that program, but for buyers who are looking for large purchases of real estate in the SBA world, and it has to be real estate or equipment, they don't do the working capital, the business acquisition, stuff like that. It's a good product.
Yeah.
And then there's the small loan program, which you alluded to earlier, which is typically deals that are $500,000 and less. They kind of fall into the SBA 7A paradigm, but they're typically, I hate to use the word easier, but it's less documentation. Yeah. They're supposed to move through the process of underwriting a little bit faster. And the reason for that is the Small Business Administration, especially the last couple of years, is really pushing on, don't chase these large whale deals, these $10 million, $5 million businesses, and loans, and you're a rock star and all this stuff. The spirit of the SBA was to help these smaller businesses and business owners get a foot under them and drive economy in their local communities. So they're really pushing these smaller loans now, which is great. Great to
Absolutely, yeah. And that's through the SBA Express program.
Thank you.
So it used to be up to 350. They just bumped it up to 500,000. They do have a line of credit version under that. Something that is new to the 7A, I'm curious if you've had a chance to try it or test it out through Milestone, is they just adjusted the SBA guidance this year where you can actually write a line of credit through the SBA 7A up to 5 million.
Yep, we have not tried it yet.
Haven't tried it?
No. Milestone's not.
Oh, it's not. Okay, so not even we don't get to try and throw something against the wall there.
Okay. Not yet.
I'm still looking for that. So if you are a business owner who wants a $5 million line of credit, hit me up because I want to try this system with the SBA. Because what we see with the SBA is they put this guidance in place, but then whether or not it actually comes through to execution is what really dictates can we use the program.
They effectively say, hey, this is a new great thing we're allowing you guys to do, but then it's up to you to figure out how to do it.
Yeah.
And a $5 million line of credit takes a lot of capacity to monitor and work with.
You better be making about 800, 900,000 in free profits a year if you want a $500 million loan or $500 million line of credit.
I'll take a $500 million line of credit.
Yeah, no kidding, right? So equipment finance, obviously you guys specialize in that. That's how you were born, right?
Yep, it's not my specialty, but we're a mid-ticket lease company. We facilitate equipment finance. I'm not the guy to ask that, to be honest with you. That's on the other side of the fence. I really try to stay in my lane. But
I love hearing that.
Yeah, Lease Corporation of America, previously, now Milestone Bank, was a predominantly lease lease facilitating company.
Okay.
Yeah.
Right. So through equipment finance, it's a way that you can typically find an easier path to financing if you're purchasing equipment. So we have lenders in our portfolio that'll do startups, right, where you're going to need maybe as much as 25% down. And then for operating businesses, things like that, it can be as little as 10% down. But the nice thing is you can actually do equipment financing through the SBA.
Mhm.
And many times you can get a more favorable rate through the SBA than you can through equipment finance.
Mhm.
Next, we talk about commercial real estate, right? So again, you can do commercial real estate under SBA, either through the 7A or through the 504, but you can also do conventional lending with a lender, which is, commercial real estate, which is very common and basic. Kevin and I have done plenty of that through our previous employers. One of the biggest differences you're going to see is when you start going in the conventional world, it's about the cash in the game or equity, skin in the game. We'll talk about that a little bit later and what percentages look like. But with the commercial real estate, you're going to need 20% minimum. What we've seen since especially like with the COVID bump, that the prices were accelerating, rents were accelerating, that even though 20% was a guideline, I mean, most deals we were getting done wouldn't get done unless you were getting like 25. I think we closed a big one where it was like they had to put 35% down.
And it's
in order
because
to make it happen.
property values are appreciating, but rents are not catching up. So if you want to, you want to buy an office building and I'm the seller, I know what it appraised at and that's what I want for it, but it doesn't cash flow. It doesn't generate enough income to cover that debt because the rents haven't caught up.
Yeah.
Or vacant, like office with COVID.
Oh yeah.
Before COVID, Steve and I office all day. Yeah. You want to buy an
100%.
office building? Yay. That's easy. After COVID, it completely flipped where office was at pretty much the bottom
industrial
because of the vacancies, because of work from home.
Yeah,
so now you're seeing this huge juxtaposition between sellers and buyers, where the buyers and the sellers are just not coming together on the same page unless the buyer's willing to drop 30-40% in equity. It's an interesting time in office right now.
Yeah, well, because the value instantly pop up based on the markets and demand and things like that. But when you're in a commercial building, you're signing a 5 or 10 year lease, and they typically have like a 3% annual increase, right? Unlike in single family real estates, where after 1 year I can just say, hey, no, rent's gone up, I need to go with the market. In commercial real estate, I'm waiting 5 years in order to make that adjustment.
Yep.
And oftentimes in commercial real estate, it's smarter to keep a good tenant than it is to increase your rent and try and go get that market rate, because you may stay empty for a year and a half to get it, or you may get a bad tenant coming in. And so it's a whole play there where you just see kind of powers that aren't equalizing well.
Yep.
Next, we have bank and credit union lending. So this is going to be just any type of specialty lending. Credit unions are great for their lending capacities. We have a few really good ones in town, and they'll offer many different types of programs. But the nice thing about a credit union, for instance, is they don't answer to shareholders. So whereas I was working at a major organization, they're shareholders, so they have to generate a certain amount of profits. They're publicly held companies, so there's so much reporting and compliance with them. With credit unions, those are member owned. So like when you open up an account at a credit union, they'll say, hey, you got to put this many dollars in our member share account or our member savings account or whatever they call it at their institution. And that is you getting a piece of ownership in that credit union. And so those are powerful because they can have a little more flexibility sometimes. But I will tell you what we've seen ever since COVID, with the way that we've seen loans fall out, businesses at risk, the playing field's been leveled. Like it used to be like secondary lenders like a Milestone would have a huge advantage at getting deals done, but their interest rate would be so far above. You'd be getting 2% higher with them than you would through a national lender, right? Well, now with all that risk those national lenders taking, they're doing the same thing. Like everybody's doing variable rates on SBA 7A programs, where pre-COVID, you could go to like a Wells Fargo, US Bank, Bank of America, and get a fixed rate on an SBA even without collateral involved. Today, you can't do that. And now the interest rate they're offering is only like 0.5% or maybe even 0.25% difference, right? And so that's why I work with a lot of non-traditional lenders nowadays, because for that 0.5 or 0.25%, it's so much worth it for you to know that you have someone fighting on your side that's going to push to get a deal done instead of look to find a way to say no. Next, we have some alternative lending. So one of them that I love working with, and we'll bring a CDFI in here. We have previously, a couple months ago, I brought my favorite CDFI. But CDFI stands for Community Development Financial Institution. So those are nonprofit organizations that are set up, and they're typically either mission-based, projection-based, or collateral-based, right? So the idea with a CDFI, so locally we have Access Capital. Access Capital is what's called a mission-based CDFI. They're here for women and minorities, and they do micro lending. So I think their largest is maybe 250. I don't remember exactly where it's at nowadays. But when it started out, it was very small. And it's like, hey, this is all we lend to. You need to be a minority. You need to be these things, because they're set up to help the economies that haven't been supported by the large banks. Okay. When we talk mission-based, it's also about the idea that they'll have a certain group they focus on. So I have a lender that they closed an SBA score with a 595 credit, right? Because it was a minority serving minorities in downtown Minneapolis, which was significantly lacking this particular service. That same one right now is looking to support a deal that we're bringing in that is a minority supporting minority tourism here in Las Vegas. Right. So it's another idea of the same mission base. Now, I don't know if we're going to get it done because SBA has guidelines, right? 640, I believe, is their minimum credit score they prefer.
Yeah, but again,
there's wiggle room.
There's wiggle room. I don't like to advertise this much, but yes, in context, I've gotten deals done for people with 540 in that range. It just has to make sense. This goes back to character.
Then those 5 Cs, right? They probably have really good capacity, right? They probably have
the deal was extremely strong. And there was some medical debt, and some other issues that have been resolved since then. And you make a decision, and you build a relationship.
When you look at these 5 Cs, so the triangle of them, or the key is credit, capacity, and collateral. You need at least one of those minimum to be very strong, and ideally you want at least 2. If you don't have any of those strong, you're going to have a really hard time finding a deal. So what Kevin is saying here is like, okay, if credit is just destroyed, then you better have good capacity. There better be some collateral, and you better be able to meet all these other conditions and present yourself and your organization in a truthful way, right? Being honest and upfront from the start is huge on that. When you say, come in, hey, I have horrible credit. I have this, I had all these things, but here's all the things that are strengthening my deal. And those can help to lead to get deals done. All right. Next, we have just the ways of financing. So we look at projection-based. I only have one that projection-based nowadays. After COVID, we've seen projection-based kind of die out, where organizations are not so much comfortable say, hey, this is going to happen in the future. They want to see what's happening today to support that. Then we have debt financing, which is not as common, but that's where someone's going to just come in and they're going to do the debt financing. That's also falls in line with revenue financing. And these are what I classify as high-risk lending. These need to be your last resort. So if a lender is willing to give you a loan off of 3 bank statements and an application, that's high risk debt, and I strongly advise against it, right? Think of it this way. The less you have to provide to get the loan, the more high risk it is, meaning the more you're going to pay an interest, things like that. There's a term called MCA, Merchant Cash Advance. That's the #1 type of high risk debt that I recommend everybody stay away from. They have factor rates as high as 30, 40, even 50% on the front end. So even if you're successful, guess who's making all the money? Your financer. You're still typically losing money, right? And those type of deals are actually where a mission-based lender can look at and say, okay, can we refinance this to help you out because you got stuck in a bad spot? And we've seen that a lot during COVID, and those are some of the deals that we're looking to hopefully replace. All right, so let's talk a little bit about lender preference. The idea that just because the lender said no doesn't mean you're not lendable, right? You could be going to the wrong lender. A couple examples of this just on a large scale. If you are a restaurant, Wells Fargo does more SBA lending to restaurants than anybody in the nation, and they've been leading that for quite some time. If you're doing construction here locally, Nevada State Bank and Bank of Nevada, they both like construction companies. So there's ways that you can work with them on those. So you need to identify what does a lender like, or what are their preference. So what are some of the areas of preference that you guys have as it pertains to types of companies?
We like both of those, actually.
Yeah? Oh,
yeah, nationwide. Yep. The only thing that Milestone doesn't really like is the trucking industry right now. And you're going to find that across the board for the most part with lenders. That's freight trucking, collateral on wheels, basically. But other than that, in prohibited businesses, we are doing construction right now. We are doing franchise performance rep.
Ooh,
yeah,
for franchise
and non-franchise for the right borrower too.
I just left the meeting. We're talking about a franchise.
Hey, there you go. This is why we do
You'll
this.
Like this one too.
Yeah. So for the right borrower, we really will look at every deal individually and try our best to find a solution. Okay. But yeah, trucking's really the only thing that we kind of snub our noses at, and everything else we're willing to take a look at.
Okay. And so as it pertains to market share, we have the question, where and how are you currently lending? So you've mentioned you're nationwide, right? So all 50 states.
And Puerto Rico.
And Puerto Rico, yes. What about Guam?
And Guam, yeah.
Oh, nice. Any of the U.S. territories. So that's like 53, I think, right?
Yep.
And then the lending you focus on. I know you particularly are SBA 7A, none of the other SBA programs. Is that accurate?
That is correct.
Okay. So the SBA 7A is like a utility belt. You can fit almost anything in there. As long as it falls under SBA guidelines, you can do it through the SBA. So you can see why I work with a lender like Kevin and like Milestone, because in essence, they can get all kinds of things done. And in particular, I think I saw some posts where you were financing some things that we just could never get done at our previous lender together, right?
Yeah, the most recent one was, a restaurant in El Paso, Texas. That was a startup construction deal, and we got it done. So they're in construction as we speak and looking to open before the year's out.
That's awesome, right? So startup restaurants are one of the riskiest deals you can do. I think it's something like 85% of all restaurants fail within the first 2 years or something like that.
Could be. Yeah, it's
pretty up.
That's why we really like to look at the franchise ones, because they've got some historicals on their own as a franchisor. You're less likely to fail as a Capriati's than you are as just Steve's Sandwich Shop. Though I'm sure your sandwiches would be delicious.
Oh, thank you.
But
I was born in restaurants, actually.
There
My family owned one growing up, so you don't even know.
But we like those deals. Yep, and we're nationwide. Truly, I've got deals. Las Vegas is my home, and I like to focus on this community. But we kind of wherever we can get the business and meet good clients.
Awesome. So all over the nation, love hearing that. The next thing you want to talk about with your lender is, do they even have the right product for you? Okay.
Yep.
So as we've discussed with Milestone, 7A all day, there's a tons of things they can fit in there. If you're an operating business and you're looking for a line of credit, that may not be the best fit for you. Sounds like, right? Okay.
Yep. So, I mean, again, we'll always look at things, but you're in the industry long enough, you kind of learn what you're good at, what you like, and then you don't want to put the client through a lot of, what is the term? You don't want to put them through a lot of hell, I guess, for lack of a better way to put it.
A bad experience.
A bad experience.
Good people through bad experiences.
So we work with people in the community and peers and colleagues to try and get a good fit for that client either way.
Yeah. And that's a large part of what my organization does to help, is we help to identify what is the right product to fit. Is a 7A right for this? Should we looking at an SBA Express? Should we be going to a conventional lending? And then from there, we can say, okay, based on the product you need, here's some of the lenders that we know that offer this.
And given the quick no, right? Like that's the most important part of it. And you're very good at that. But really, if you come to me and Steve's the catalyst and you say, hey, is this something you can do? I won't name names, but a lot of lenders will say yeah to everything, because they just want the, sure. And then they'll send it up to the mothership and they'll hope for the best. And then it's a couple weeks and you haven't heard yet. And there's a follow-up questions. And before you know it, you as the borrower, you're a month into this thing and you have no concrete information. What we like to do at Milestone is, if we can help you, we're going to move as quick as we can to get you something concrete to hang your hat on. But if we can't do it, we'll tell you up front, we can't do it. And maybe Steve could find someone else who's better at this than we are to do it. And that quick no, I mean, even when I've had clients or prospects I've said a quick no to who come back for me later when it's something we can do, because they just appreciate that I value their time. Yeah. And that's, I think, the most important thing really, is just that quick no, quick 100%. Communication and picking up the phone. Like nobody picks up the phone anymore.
They do not.
Yeah,
and you can tell Kevin and I have worked together, because actually one of the things is a requirement to be a lender in my portfolio. You have to be able to provide a quick no. And I have no problem when you want to pass on a deal. I actually have more respect for you when you pass on it in the front end, instead of saying, oh, I think we could get this done, but right? So that's highly important. Next, I think the mission is important. So particularly if you know that you are not super strong on all those 5 C's, then finding a mission-based lender is crucial, right? So if you're a minority, go find a mission-based minority lender, right? Just because they were created, particularly say, hey, we can make exceptions for people that are minorities, or for women, or for veterans, or for any type of specialty lending. Believe it or not, there's a ton out there that say, hey, we only do restaurant lending, or we only do factor financing, right? There's so many different organizations that have different missions. So identifying is, am I barking up the right tree, in essence, right? Or am I sitting here, I'm not even in the right park? There's ways to easily identifying that by asking your lender, does my organization fall within the mission of your organization? And then lastly, we talk about the financial plan, right? And this is just really the idea of, how is that lender currently situated in the market? A good example of this is, so I worked at Wells Fargo for over a decade, right? And I was there when they announced all the bad and they got the handcuffs put on by the CFPB. I was at a different lender, US Bank, when the PPP loan came out. And within, I think, 1 week after the PPP, Wells Fargo was no longer able to issue any more PPPs because they were under strict guidelines by the CFPB, the Consumer Financial Protection Board, that says you can't have any more loans on your books, period. You're done. My phone blew up because I was a former Wells Fargo employee, and all my former Wells Fargo clients were calling me like crazy because they couldn't get a PPP from their lender.
Yep.
Right now, that's one specific example. Another example is, what's the size of my loan? Let's say you're going for a $5 million loan. A newer regional bank that just opened 1 or 2 years ago may not be the best source for you, right? Or if you want a $20 million loan, you can't go to a bank that can't support having a $20 million loan on their balance sheet. And these are something as an average consumer, you're not going to know, right? And that's perfectly fine. That's where we step in and we can help, or, you can talk through it. The nice thing is with the SBA program, you can go up to 5 million. If you need more than 5 million and it's not real estate associated, you're going to have to jump into the conventional space or the secondary market. And you're going to need to make sure that your loan doesn't represent a major portion of their portfolio, because they're managing risk just like anyone else manages risk. So if they only have 100 million they can lend out at any given time, they're not going to issue a $20 million loan, because then 1/5 of their entire portfolio risk would be based on you and your transaction. So if something happened to you, that would be so detrimental, it would destroy their returns of the rest of the portfolio. So understanding the size of the lender comparison to your request. The nice thing is this typically only comes into play when you're jumping over 5 million. If you're staying under 5 million, you don't really have to worry about this, but I think it's important to mention because you can also have lenders that have just gotten in trouble. I work with a CDC that I'm not going to name, but they were under legal. They were being sued by something that happened in the PPP. So because of that, they were not issuing any loans for anybody for an entire year, right? When you run into those type of things, so lenders have risk. They take, not everybody pays a loan back, right? I hope that's not a surprise, but because of that, they have risk they take on. So however they're situated in the market also plays into the determination of whether or not they would be the right lender for you or you would be the right borrower for them.
Yep.
Okay. So let's talk a little bit about the terms and pricing. So as it pertains to my Milestone and the SBA program, what is the typical terms, amortizations? Walk us through some of that.
Yeah, we're a preferred lender at Milestone. Now, a preferred lender just means that we can basically underwrite our deals in-house. And then the SBA, they do their due diligence, and that's how you, as opposed to
stamp off on it.
Yeah, I mean, as opposed to a lender that basically has to underwrite it and the SBA re-underwrites it and you double your work. We are a Prime Plus lender, which is pretty common in our space.
Yep.
Especially in the business acquisition field. So the prime rate is, as of today, 7 3/4. Yep. So if you were to buy a business, your interest rate is going to start off at that 7 3/4, and then we're going to build a spread on top of it. So average is 2.5% in the market, and that's just the market average. So 7 3/4, 2.5%. You add those up. What is that? 10 1/4.
Yep. 10.25.
And then your interest rate effectively for borrowing capital to buy a business, commercial real estate, can vary, but it's typically around 10 1/4 right now percent. Milestone typically does variable interest rates, meaning that every quarter your interest rate will adjust to prime, which in this environment is a great thing because the interest rates are going down. So if it's 7 3/4 today, and then 3 months from now it's 7.5, your rate just dropped down a quarter automatically. But that's pretty common. Our terms, we really only have, you have blended rates and blended terms and things like that, but typically any loan that is non-commercial real estate is going to be 10 years or 120 months. And that's full principal and interest all the way through with no balloon payment. You just pay it off. And then if commercial real estate's involved, let's say you're buying a building or you're buying a business that has a building and that building's 51% of the total transaction price, you can go all the way out to 300 months or 25 years, which is super nice. So when these guys are coming in to buy these businesses that have real estate, they're in a great spot because you've got a 25-year loan automatically just because the real estate component.
Yep.
Yeah, that's pretty much it. And then so term and rate, and then I guess processing time, 60 to 90 days on most loans.
Okay, yeah. And then so we have this thing called stipulations, or we always say stips, right? Oh, I'll follow up on a deal I've sent in, like, okay, yeah, we're going to approve it, but we're going to stip for this, right? Or stipulations. And this goes back to that conditions,
Yep.
right? So a stipulation is basically anything that they're going to require in order for this loan to close. So we're going to require your spouse to be a co-signer on this. We're going to require an extra 5% injection
Life
because
insurance.
the capacity. Oh yeah, that's a big
That's
one.
a big one.
Yeah,
Yeah.
any deals, pretty much all the lenders I work with, any deal that's at more than $500,000, they're going to require you to get life insurance. Yep.
Mhm.
Yes, I'm assigning a life insurance policy right now for a client we closed last time. So not only will they make you get life insurance, but then you have to go to the life insurance company and sign off or assign it to the borrower or to the lender saying, hey, if I die, the beneficiaries I listed don't actually get this money. You get it instead. Yep. Now they're requiring you to buy it for the transaction. So if you have your own separate life insurance, you can keep that and just go get more.
Yep.
What I typically do with clients in this case is get term insurance. I am a licensed insurance agent. I didn't get it for this. I've done it for 20 some years prior anyways, but it is a requirement. Did you have a question?
Yeah, could you, why is that even important? Like to have life insurance, even without a loan, like why is life insurance going to be important for a business owner?
Yeah. So, I mean, as it pertains to the loan, first of all, right? Remember how I said your business doesn't exist without you? So most SBA loans are written for small businesses, less than 10 employees. So you as the owner usually have some kind of information or have developed some kind of process that is proprietary and won't exist without you. So this helps the lender in satisfying the risk involved if you pass away. Now, outside of having a business, let's say you didn't even get a loan and you have a business operating, right? Well, that business isn't going to operate the same without you. Odds are it's not going to generate as much revenue as it did previously. So there's a thing called a key man policy, which I strongly recommend for any operating business. A good example is I have one company I'm working with where one person is like half of the magic sauce and the other person's the other half of it. You put them together, they're doing millions in revenue. Really great combination, right? If one of these people, one's the technical expertise, the other one is like the people and all the organizational stuff. So the company doesn't operate the same without either one of these people. Having life insurance can give you the capability to go find someone with that same expertise, or it can pay off debt. It can actually ensure that your family or the relatives, the people left behind, have some capability or means to survive. Because what happens in most businesses without insurance, the person dies, the business instantly turns to failure. And now what used to be providing livelihood for a whole family or a whole, group of families, because there could be employees, like now your employees are at risk, your employees' families are at risk. So life insurance is a smart idea to protect you, to protect your business, but more importantly, to protect the families that are dependent upon your business and the revenue it generates.
So does life insurance fall under collateral?
If it's a cash life insurance and there is a cash value, that could absolutely be collateral. If it's just term insurance, then no, it wouldn't.
It's a great question.
Yeah,
What
that's a very.
makes a person insured?
That's a whole other thing. We got to go through risk.
We don't get involved in that. But
Yeah, that's something we would have to take offline on this one. Mhm.
You said a guy, how old is the person?
Yeah.
Okay.
No, well, and that's what I'm trying to say is we're going to get so sidetracked.
Like, does he
Yeah.
race cars?
Yeah. Have you flown on a non-commercial flight in the last 2 years? Do you do skydiving? There's a whole list of other questions. I'll happily answer that offline, but that'll get us so far off of lending. But yeah, you have to qualify for it as well. Here's the nice thing. If you can't qualify, then we just give them a letter and now they will waive that requirement because they can't ask you to get something that you can't get. Now that could be something that they may decide, hey, that was a stipulation. That was one of my conditions. And they could decide, well, without that, we're not going to do the deal. Most lenders I've worked with, if you can show them that you're truly not insurable, then that's one. But you can't just go to one company, right? Like I guarantee I can get most people insured in this room in some capacity, right? You just may not be able to get the full loan amount. But those are things you have to take in consideration. The other thing we talk about is lending fees, right? So there are fees that they're going to have to pay. This is, if you're going to do an SBA loan, you're going to pay Kevin or you're going to pay any other bank to underwrite you. Okay. And I like saying this part, so he's not the bad guy, but there are third-party fees. They're going to do UCC filing searches, credit reports, background checks. They're going to do all those things. All those things cost money. They're going to charge you for that upfront through what's called a good faith deposit. Now that can be as little as $1,500. That can be as much as $5,000 in some cases. It really varies from deal to deal, but it is something you have to understand that you are paying a lender to underwrite you so that you can get their money. And I know that sounds a little messed up, but it is the
But
truth
the
of
good news
matter.
about that, and something that I always point out, is that that's not a fee on top of your equity injection. So if you're coming into a deal at 10% down, and then we're going to finance 90, that security deposit is a part of that equity injection. So let's say $500,000 is the loan amount. You have to come in with 10% of that. That $5,000 security deposit is considered a part of that 10%. It's not on top of. So it's part of your equity injection that you would have had to pay anyway. But to Steve's point, it's so that we're not left holding the bag if the deal falls through, and we've already paid for the UCC search. We've paid for third-party reports, business valuations, appraisals. We get that money from you, and then it's part of your equity injection. So, yeah.
Sorry, we're running long. We're not going to catch our 3
Right.
o'clock.
Yeah. For us, it's fully refundable unless we've already spent it. So if we did an appraisal for you, and then at the 11th hour, the buyer and the seller just don't get along and the deal falls through, but we've already paid for that appraisal. Unfortunately, it's the borrower. Yeah, you've already paid for an appraisal that's not going to help you too much.
And we're going to talk about a
that's
process
part of the risk,
to help you avoid that.
Yep.
I think it's on the next screen. I pushed our 3 o'clock to 3:15.
Okay.
Next is you're going to have interest rate, as Kevin has discussed. In the SBA world right now, through the 7A, unless there's real estate involved, everybody's doing variable rate. I don't know a lender that's not doing variable rates on the SBA 7A right now, no matter how strong your deal is, unless there's real estate involved. Now, the only thing that's different is what Kevin alluded to is the spread. So they're always doing prime plus. So at some of the larger, more secure lenders here, I've seen prime plus as little as 1.75. At some of the higher risk lenders, or what the SBA maximum, I believe they max out at 3.5, right? So under the SBA, the nice thing is no one can charge you more than prime plus 3.5. The industry average that we're seeing is about 2.5, as Kevin said. So today that cost of funds is at 10.25%. It could be slightly lower. It could be slightly higher, depending on which lender you're working with, and also the risk that your transaction presents. The more risk your transaction presents, the higher that spread could be. If you come in and you're solid on all 5 C's, then you might be able to get that down to prime plus 2, right? Or if you want to go through a major bank and you have everything perfect in order and you're okay with, it going a lot longer than whatever they told you, then you might get down to as low as like prime plus 1.75 or prime plus 1.5. I haven't seen anything that low, but technically you can get that low. Then what about prepayment penalty? Do you guys have prepayment penalties?
We do. Milestone's pretty generous, I think, and unique in this. So any loans that are 180 months or shorter, we don't charge a prepayment penalty at all.
Okay, so 10 years or less, no prepayment penalty. That's
and then
nice.
over that, we do what's called a 5-3-1 step down. So in the first 3 years of the loan, the first year, the penalty is 5% of the principal, 3% in the second, and then of course 1% in the third year. And then on the fourth year and thereabouts, there's no prepayment penalty. Mm-hmm.
Awesome, right? And the reason those things are in is the costs they incurred, right?
Yep.
While you did pay some fees, those 3 third-party fees, you didn't pay Kevin's salary, you didn't pay the underwriter's salary, their technology costs, right? There's all these expenses that a lender has in place in order to just operate and get a deal booked.
Yep.
And if they spend 2 months working with you to get a deal booked, they expect that revenue, that interest, to be paid for a 10-year period. They want it for that period. That's why they're doing the loan, right? So you have to think of that consideration, that the prepayment penalty is to help offset what revenue they expected or profits they expected from your deal if it gets paid off early, and that's why there's those penalties. Now, one of the cool ways you can get around this, and I'm just curious if it works with Milestone, is you can pay it down a lot, right? Some will even have, do you have limits of?
We do. It's 20% per year.
Okay,
20%.
so you could pay as much as 20% per year and not have penalties with Milestone. And many other banks are similar, like 20, 25%. I think I know one that goes as much as 50%. But so there's ways, like if you're doing really, really well and you want to pay it off, you can pay it off early. My suggestion to you with that would be talk to someone like myself who's really good with numbers, because if your business is doing that good, there's probably better uses of your capital than paying off your debt.
100%.
Right? Like if your business is doing so good that it's generating that much revenue, let's take that money and let's put it into what's generating revenue so we generate even more revenue, right? There's better things than satisfying debt. And this is one of the cases where when you look versus personal debt and business debt, right? Like on a personal debt basis, having a mortgage can be good personal debt. Most other personal debt we can argue against, many different ways, unless you're a super high earner or you've got super opportunities for your capital. As a business, there are plenty of ways to have good debt, right? If you've got a profit margin of 35%, why are you paying off a 10% loan? You're making 35% every time you invest $1 in your company and you want to pay off something at 10%, you're losing 25% of potential on the money you could have, right? So a lot of people don't look at it in those capacities, and that's what we help them with. So let's talk a little bit about this underwriting process. I alluded to a way that you can avoid paying fees just to get declined. So everybody needs to know this, write it down. It's called pre-flight. Anytime you are looking for a business loan, you need to pre-flight it with your lenders. And that's under this document review area. So there is a standard packet of operations that you're going to need. 3 years tax returns for you, 3 years tax returns for your business or any business you're being purchased. SBA 413, SBA 1919, 3 years worth of financial statements, year-to-date financial statements, and a debt schedule. What else?
That pretty much
That's
covers
pretty much,
it.
that's
Yeah.
gonna be enough, right?
Yep.
That's the minimum. And you can take that. And this is where I work with so many different borrowers where I say, hey, gather all these documents. I don't even sign you as a client until you get a pre-flight packet and I shop it with the lenders, because I want to make sure someone like Kevin or someone else in our lending network says, yeah, we like this deal. We think we can go forward. Then I'll come back and say, okay, now here's what it looks like to be under contract with me if you want me to procure my services. But that pre-flight you can do on your own. You can go out and research all the banks in the world and get a nice little packet together and send it out to them. And what the lender is going to do is they're going to say, I'm going to assume your credit is wherever I need it to be approved. And I'm going to look at everything else on the deal. And I'm going to tell you whether or not I like that deal. And if you like that deal, what happens?
Then we get a full packet.
Okay.
And that's also what separates the good bankers from the bad ones, in my opinion, is being able to pre-flight a deal and tell you whether a deal is viable or not before you go into underwriting, run your credit.
Yeah.
But if we like a deal, the way Milestone operates, we'll get those 7 or 8 essential documents, the minimum viable documents, whatever you want to call them. We'll pre-flight those. We won't run your credit. We're not going to try and waste anybody's time. And we'll say, okay, based on what we know and based on what we have, do the numbers work and do we like the deal? And if we like the deal, we'll give you I hate to call it a pre-approval letter. It's more of
it's a LOI.
an LOI, a term sheet. We call it a proposal letter. And that's where rubber starts hitting the road. And we say, okay, we like this. Here's what we're proposing to you, those stipulations, all of that stuff. Here's the rate we're proposing, the term. Maybe we're going to ask your spouse to be on the loan. Maybe we're going to collateralize a couple properties, whatever it looks like. What do you think? And if you like that, you say, yeah, I like this. You sign it. You return it back to us with that $5,000 security
I was going to say, it also tells you what's required as a good faith deposit.
Yep. And with the wiring instructions, it's all there. And then that's where you're like committed somewhat, and we start underwriting the process. We get a full application packet from you, all the boring paperwork. We help you with that. And then we go in through the underwriting process where another person basically takes it from me. 2-3 weeks, they review it and they get really granular into detail with the deal. And then there's some back and forth, just like any lending. And they're going to ask you some questions. Then I'm going to relay those questions and I'm going to help you. And God willing, you get an approval and we go into the closing process.
Yeah. So I like that. You guys call it a proposal sheet.
Mhm.
Okay. So other lenders I work with, they'll call it a term sheet. One of the other common names for it is an LOI or a letter of intent. So you will get a letter that says, we like everything we've seen so far. Here's what we'd offer you. Here's the rate. Here's how much you would have to pay us as a good faith deposit to get this process started. And the nice thing is you can shop out multiple lenders. And that's what I do so often for our clients is identify 2 or 3 lenders because everything's going to look different, right? So for Kevin, you just mentioned, typically yours is going to be about a $5,000 good faith deposit.
Yep.
I have some lenders that it's only $1,500. I have some that it's $2,500. I have some that it's 1% of whatever your loan amount is. Right? So there's all different kinds of variations you're going to see from lender to lender. So going through a pre-flight process is crucial no matter who you're working with. I love how you stated that that's really kind of what separates the bankers that know what they're doing versus the one that maybe not. Right. So that's just our document review, our pre-flight. Once you get it through that, then they're going to go through the credit review. Right. So this is where you've paid your good faith deposit and they're going to give you a few more documents they need. And then they're going to send you through to underwriting. Now that underwriting process can be as short as 2 weeks with some, even though they're pushing to 3 weeks now. So really it's typically 3 to as long as 5 weeks, depending on the lender you work with. So that is a part where sometimes you feel like you've gone to a black hole where you're like, hey, everything goes in here, or they only come back when they have questions. They never come back and say, hey, we're moving to the next step, things like that, right? But it's going to be a part of the process.
But I will say, not to interrupt, but
please.
That's just another example of where a good banker makes the difference. Someone who prepares the documentation in the package, putting your best foot forward to reduce that underwriting time. The difference between 2 weeks, a lot of that can be mitigated on the front end when you say, okay, I anticipate they're going to ask this.
Yeah.
I anticipate they're going to want that. Let's get ahead of the story now. So when we present it, we can say, no, we know you're going to ask that. We already have an answer. Boom, that's a week, and that's how you shave off time. So
absolutely right. After we hit that underwriting review, they're going to reach a decision. Hopefully you're going to be approved. You shouldn't, ideally you should go with someone where when they're pre-flighting a deal, they're pretty positive they want to approve you. So unless something comes up under that credit review process that was not known to them, you should typically be reaching an approval with someone who writes a commitment letter. Now, don't get me wrong. I'm sure it happens. Offenses that, right? There's times when things are not known that come up, but for most parts, the lenders that I work with, if they are issuing out an LOI or a term sheet, what they like to tell me is they don't like to issue out term sheets that don't get signed. So they don't like it when I shop 2 or 3 on the front end. They understand if the case needs it, like what we're talking about later today. But in reality, the idea is like, most lenders, if they send out a term sheet, they're pretty confident. One of the lenders I work with, they actually will do a hard pull on your credit in order to issue out their LOI. So that way there are no credit hiccups that come up. So the only hiccups that can come up now are through your background check or through UCC filings. I think that's where I see it a lot, where someone's suing you and either you didn't tell us or you didn't even know about it. That's happened for me and my clients before. Or things on your background check that maybe you just weren't forthcoming with. But once you get an approval, then we hit to what's called conditions. Okay, so you've been approved. Now they're sending out another list and they're saying, hey, you are approved. In order to get this loan, here's the conditions we have. Now, the nice thing is you issue a commitment letter at that point, right? Yep. So tell us, what does a commitment letter mean?
It's basically, we've underwritten your deal. We're approving it. Congratulations. Here's the list of items we need to go into we're in the closing process once we get your signed commitment letter back. And it's basically just a list of items we need to close on the deal. And of course, those vary depending on the deal, but that's where your life insurance will come into play. Like if you don't have it, this is the time to get it and provide proof to us. Or if you're buying a business and you don't have an entity created to house it yet, go get that entity set up. Provide proof of your licensing and your other insurance pieces. Appraisals, business valuations. That's where that all it's the most involved part of the process, I would say, for the borrower is the closing piece of it. Because underwriting is very like you're praying to God, please, I hope it gets approved. But mostly I'm just keeping you posted or asking you questions. But the closing process is where you're really sleeves rolled up. You got to get that stuff in. So.
And a commitment letter is an approval. It says on there, you have been approved. You provide me this, you get your loan. Now, they haven't necessarily secured your SBA loan number yet, but they have made a commitment to you that you are going to get this loan. I've worked with investors and borrowers where we get a commitment letter, and now we're like, okay, cool. We had 3 investors waiting on the sideline because they were going to provide our cash injection, or what we call the skin in the game. So we go to them, show them the commitment letter. Now they're ready to write checks to get things done. Once we go to that process and you submit every single piece of those documents, then we finally go through this last piece, or what's called the compliance review. That's when the lender actually has everything packaged nice and tightly up, and they send it off to the SBA. The SBA will do their review, where if you're part of the PLP or preferred lender program, they're reviewing everything. They stamp it. I've seen it come back as fast as 48 hours sometimes, right? Sometimes a little bit longer. But when that compliance review is done, now you have an SBA loan number set aside. The SBA has set aside the funds there, so you are good, right? Your money is coming. And we even saw this in like the EIDL program where they said the money ran out. But if you were someone that had already gone through the compliance and you were just waiting to sign, your money was already set aside and it was there for you. So the compliance review is highly important, because the reason the SBA program is so powerful is a lender like Milestone Bank is to say, hey, we just did this $1 million loan. And once the SBA stamps it and they send it off, the SBA is going to pay them 75% of that back to them as a lender so that they can go out and make more loans.
Yeah, it's like insurance. Yeah. They guarantee, the government guarantees it, which is great. It's great for the lender. It's less risky, but that's also why
there's so much paperwork.
There's so much paperwork because it's the government, and everything. Every T has to be crossed, every I dotted perfectly, and they will send stuff back. And I've had many borrowers say this seems nitpicky. It's like, the federal government can be very nitpicky.
But without that 75% guarantee, a lender like Milestone or any of the other lenders I work with would be even more restrictive on how they let their capital out there.
It's a great program, because otherwise startup financing would collapse in on its itself
I
because it's
think
just too
7A
risky.
is the only way we're doing startup financing.
And it really
nowadays.
is. It's the
Yeah.
government and the Small Business Administration wants to generate revenue for the economy with local business owners. I mean, it's the heart of it's a really nice thing.
All right. So you've gone through all that. You're at the closing process. You get 140 some pages that you get a review. And so, yeah, I'm not joking. It's about, I mean, the average loan packet's probably about anywhere I'm seeing them anywhere 100 to 140 pages, depending on what's involved, just because there's so many disclosures they have to provide, you know, automatic payment agreements, life insurance agreements, the application itself. We go on and on. But part of the closing process, we have this cash injection or skin in the game. So talk to us about that, Kevin.
Well, that just goes back to your 10% down payment, effectively. Your cash injection is a down payment on the project, whether it be real estate, you know, commercial real, I just said real estate, business acquisition is what I meant to say. It's your skin in the game. Some of that's going to come from your security deposit. Some of that might be money you've already spent. Franchise startup's a big one where, hey, I already paid $50,000 in a franchise fee. Can I count that as part of my equity? Absolutely. That's money you've put toward the business already. And then the difference, the rest of it is typically done with an escrow or a title company, where you will inject your portion, we will finance the rest of it, and then the recipient of those funds will receive the whole kit and caboodle.
Okay, so I got a question for you, because I know SBA guidelines can say that for down payment on a startup, it can be as much as 25%. What percentage do you guys require on startups?
I have done startup deals with 10% down. So yeah.
I like hearing that.
It depends on, every deal is different. With Milestone Bank, we look at every deal holistically, depending on the 5 C's. But yeah, we do a lot of 10% down franchise startups for the right borrowers. So and the right concepts too, the right franchises.
Okay, that's huge, because even the other lenders I work with, they only go down to 15% for startups. If you're consolidating debt, can you guys go to 0 on that? Existing business debt consolidation?
We can, depending on the debt that we're refinancing. Yeah,
Okay.
I hesitate to talk about debt refis because the moment you talk about debt refis in this business, all your MCAs come after you, and they want to do that. So we're very I don't want to say picky, but we're very selective over that. But yeah, we can.
Yeah. And so the point I want to make through this is SBA has different guidelines they set. It can be as much as 25% for startups. It can be as much as 15% for business acquisition, which we've just heard, Kevin, they'll go down to 10% on business acquisition. SBA guidelines allow you to go as little as 0 on debt refinance, business expansion.
Working capital,
right? So if you're a business that's been in operation for 2 years and you just need to grow, you may be able to get away with a 0% cash injection. So I have a client that we helped get a $500,000 loan to grow their operations. The only cash they needed to put in the deal was their closing cost, which was $5,000. But those are case by case, and that's why it's important to talk to your lender to say, what kind of cash injection or equity injection or skin in the game do you need from me in order to close this deal? In addition to that, they're going to have post-close liquidity. So what does that mean? Let's dumb it down.
Post-close liquidity is really common in the business acquisition space. It's basically how much, when you've given your cash up for your injection, your 10% down, how much money do you have left over to cover expenses, unforeseen, costs? It's like, I'll always remember when I moved into my first apartment and I didn't have toilet paper. And it kind of blew my mind that I needed to buy toilet paper because, frankly, my parents
always been there.
My parents have always provided. I never asked where it came from. And it's very similar to that, in that, like, things are going to pop up when you acquire a business that you cannot anticipate. How much money do you have set aside to cover you in case an emergency happens? Yeah. Milestone's metric is around 7%. So 7% of the loan balance is cash you need to have put aside to cover any, that's after your injection. But there are mitigants to that. Very rarely do we have someone who's exactly at 7%. And if it's below that, how can we mitigate that? A lot of times, these buyers are keeping their W-2 income from another job. Yeah. And that's a big mitigant. But that's what post-close liquidity is, basically, like your in case stuff happens money.
Yeah. Next, we have seasoning of funds. So this is the idea that any revenue that is not directly attributed to, or any cash or money in the bank that is not directly attributed to business revenues, we got to track it for the last 60 days. So if you had someone give you a loan, someone lend you money, or someone just straight out give you a gift, not only will we have to track that through your accounts, but sometimes we have to get statements from them to track where that money came from. And again, this is not, I mean, the banks require it too, but they require it because the SBA requires it. The SBA wants to ensure that every dollar going in here is from business revenues or from the business owner directly, and it cannot be borrowed money. So you cannot borrow money to hit your cash injection. That is directly against SBA guidelines. You can have someone give you a gift, in which case a lot of institutions will require a gift letter.
Just
right?
says it's not debt.
That say, hey, this is not debt. But the biggest thing about seasoning of funds is it cannot be borrowed money to meet your down payment.
Unless it's a home equity
Yeah,
situation.
so that is a new rule that we
Yep,
have this
they
year, that
changed-
if you have a home equity, you can count the available credit of your home equity as a cash injection.
So basically, you can say, I want to borrow from my home for my down payment.
Yeah.
And technically, you can do that.
Yeah. And the reason for that is because in the event someone goes bankrupt, they decide, they're not going to make their payments. The home is the last to go, right? The home is always that debt that you figure out, however, I'm going to keep making these payments on it, because you don't want to lose your home.
Plus, it's a part of your net worth. I mean, you've
Yeah.
actually built that equity working hard over the years. So,
Lastly, in the closing process, you can run into this situation where there'll be different cash disbursements. So sometimes they'll give you all the money right at once. Sometimes they're going to do cash disbursements where you have to provide invoices, other things.
construction
I was going to
projects.
say, if tenant improvements are involved or construction, there's going to be disbursements that happen along the way throughout the process, right? And what I want to do now is we're going to open it up for questions. I'm going to leave you here because our 315 is already there. So I'm going to let you field all these questions.
Throw me to the wolves. huh?
Kevin will be here for questions. I do apologize. I have a 3:15 meeting that was at 3 o'clock that I pushed back just so we could meet today. To everyone joining us online or seeing this live, we're glad that you are joining us today. We appreciate that you're there. Make sure you tag us on a follow. If you want to reach out to us, we've got the QR code. Feel free to scan it. You can schedule an appointment directly with me. You've got my contact information and you've got Kevin's contact information. And I just want to thank you all for joining us for Becoming Business Lendable, and look forward to seeing you guys next month.
Thank
Have
you
a
so
great
much.